Welcome to TheoTRADE. This is Don Kaufman. It's August 7th, 2024. Just about 30 minutes to go to the cash close here on this Wednesday afternoon. The S&Ps once again just having a wild reversal kind of a trading session. Look, here's the bottom line of this evening's video. You got to stop worrying about volatility and learn to love it. Learn how to harness this vol because, well, that's exactly what we are doing and exactly what we're going to explain here and the types of trades that we're doing right now at TheoTRADE on this evening's video. So the S&Ps at this moment, look, we're going to look down the list of some of the usual suspects. They're down about 13 handles. They're choppy, they're fast, they feel disconnected over here, but I got to tell you, this is, once again, it is a just downright wild reversal. We traded, 53.59. We're now trading 52.51. It's over 100-point reversal on the day. Taking a look at the NASDAQ, I mean, it's almost too big to comprehend on a day-to-day basis. We're seeing, 500-600-point reversals and then some. And there's 30 minutes left to go. And this is one of those trading sessions where it's like they can't ring the bell fast enough before this marketplace gets downright wicked. Let me show you, though, when I'm saying it feels fast, it feels disconnected, it feels broken. Look, in the midst of volatility, one of the first things that I want to stress to you, you have to wrap yourself around levels, okay? It's not about sitting here and trying to handicap every single move because, listen, that garbage is just futility in the midst of vol. And the S&Ps, when I just started this a couple seconds ago, we're down 13, then they were down 20, they're only down 17. All right, you're going to make yourself sick trying to kind of harness that. When I talk about major levels, the first thing you really want to wrap yourself around is the SPX expected move, not in the NASDAQ, not in the Russell. Forget about, NVIDIA. Okay, when the markets get volatile, it's about the S&P, it's about the SPX, and you got to get that in your head right now. What are the levels in the SPX? And you could take those levels in the SPX and you can translate them into S&P futures kind of language, right? So if you take a quick glance at the SPX, where are we right now? Well, we're the lower edge of the expected move, right? And that amounts to right here, okay? And I'm actually going to label that on your screen. It's 52.09. Again, this is 52, okay, 09. Why is it so important? Because we keep actually hitting it and kind of reverberating off of it. And I'm going to tell you, all right, from now until the end of Friday, right, through the end of the week, okay, that is going to be the critical level to watch. Because if we lose the lower edge of the expected move, that's a gaping hole to the downside of markets. And again, I want to stress this because what you're looking at right here is a weekly expected move. And this week's expected move, somewhere in the neighborhood, I'm just going to round it to about $137, right? What have we done this far? Well, obviously a precipitous drop on Monday. There was a rip your face off rally on Tuesday. It faded hard, okay? And again, I want to actually take you into this when I say, oh, you gotta substantiate around major levels. And I'm talking about a rip your face off rally here. Take a look, obviously, at Tuesday's trade. We ripped right all the way up to 53.10. Let me tell you, 100 handles means absolutely nothing because then we turned around and faded. In fact, when the market and the bell went off, well, we kind of closed at 52.40 yesterday, but really the S&P futures faded directly to where we are right now. I mean, inside of the S&Ps. And the exact same thing has kind of played out today. So we ripped from the get-go and been fading throughout the course of the day. Nevertheless, again, as I said, you can try to handicap like, oh, we're going up, we're going down, we're going to do this, okay? It's futility. It's futility. Right now, you got to worry about this 52.09. The reason you got to worry about that one, so tomorrow morning, there's going to be a multitude of catalysts. And again, everything in volatility, okay, is about levels and it's about catalysts. It's not about trying to handicap every single move because, as I said, you're going to sit here, you're going to drive yourself completely insane trying to pick out, like, who cares? Oh, it moved 10 handles. You shouldn't even care at this point about 30 S&P handles. You're going to go higher or lower by 30 handles like it's absolutely nothing. And in a moment, I'm going to show you how to trade it. But you shouldn't care about 20, 30, even 40 S&P handles. Major level here, okay, of the 5209. If we get below it, okay, it's going to feel like a precipitous and unrelenting drop at that point. Moreover, if we get below it, then and only then are we going to see volatility really start to go kind of parabolic again on us. So as I'm stressing to you, all right, you saw the reversal, you saw another reversal. Now you've got some catalysts, as I was talking about tomorrow morning. What are your catalysts? Jobless claims. Yeah, people are like, well, jobless claims come out every single week. You shouldn't care about that. You should at this point. Those jobless claims, okay, rise, meaning that, well, there's more people jobless. Bad news has been very bad news for the markets lately, and that could be a catalyst to drive us substantially lower, right? So you got to look for catalyst number one in there. And I'm not going to tell you which way that catalyst, because that catalyst could spark this market either way, right? So obviously, though, I would look if that jobs number is not great. You see the S&Ps go lower, and you're actually going to see the rally inside of the bonds, okay? Next in the docket, then you got wholesale inventories. That's another major catalyst tomorrow morning. Like, look, there's not that much news coming out this week. This is like, B or C level data. Like nobody cares, oh, wholesale inventories, jobless claims comes out every week. Nobody cares. You should care this week because you got nothing else ahead of you. You just have nothing else ahead of you. You want to talk about the labor force survey? I'm just joking. That means nothing. All the data coming out here is Thursday. Like you think we've been volatile? We haven't even hit any big catalysts. Moreover, when we start to hit bigger catalysts, I want you to see inside of the SPX. The reason I'm saying this, like, don't worry about 20, 30, even 40 points in the SPX. Why? Because check this one out. Put on your big boy pants. You have a $77 implied move between right now and effectively tomorrow's close. That's tomorrow. You have over 100-point move between now and Friday. That's volatility, people. That's volatility. And as I said, the whole thing is right now, we're catching and holding the lower edge of this expected move. You start to get outside of it, things are going to get downright wild. Speaking of downright wild, let's go take a look at VIX. Because right now I got the S&Ps down a little bit, and you're like, but the VIX is down, man. That's because we already had what we term a volatility shock, right? At the first sign of risk, the volatility overreacts. Like, oh, I've never seen this before. Holy crap. And the VIX hits 65, right? This is like, walking into a dark room and somebody jumps out in front of you and scares the living crap out of you the first time. All right, well, by the second or third time, you're going to be expecting it a little bit more. So what happens? Volatility kind of subsides a bit. And that's exactly where we are. So what do we need to see volatility go a little bit higher? You need to break below the lower edge of the expected move, period. That's what it's going to take to get volatility to go higher. And the reason I'm bringing that up is, that's going to provide lots of opportunity, especially for those of you trying to sell premium. Now, that's not written in stone. We don't necessarily have to go below the lower edge of the expected move. But I'm going to tell you right now, we're going to be talking about this, 5209, even on the weekend update, because that's make or break, between now and the end of the week in this marketplace. Okay, let's push that aside for a second. As I was saying in here, you got to stop worrying about volatility. You got to learn to love it. The crazy and cool thing about volatility, and it's both crazy and cool, but you can use things like in-out spreads, be dead wrong one day, okay, and profitable the next. You got to use things like defined risk spreads, okay? You got to scale size back. Let's start with size. First and foremost, most of you are comfortable and have been trading, okay, recently in like a 12 volatility. So let's say normally you trade some option contracts. You're like, yeah, Don, I trade 10 option contracts. Yeah, you trade 10 option contracts in a 12 vol. Now, okay, where's your vol? 27. How big are you trading right now? And I'm not trying to pick on anybody. I'm saying, like, have you scaled back? You got a downshift. Why? Because you're getting, let's just say it's, almost 3 times more movement. You're getting almost 3 times more movement, and people don't get that. You got to scale back size. If you don't scale back size, you're getting 3 times more movement. That means your capital, okay, is extending itself 3 times further than it had before. You got to downshift. You got to downshift contract size, especially if you're trading futures on an intraday basis. Normally you scalp, 4 or 5 micros. Okay, at this point, sorry, be capped in 1 lot, be capped in 2 lot, wear the cape, jump around, do whatever it does. You got to downshift. Got to downshift trading size or you're going to get killed. Number 2 on there, use defined risk spreads. Give you a perfect example of a defined risk spread. Notice I have nothing on Meta. Want to know why? Because I both entered and exited the Meta trade profitably today. Earlier today, I put on a defined risk, okay, bearish trade inside of Meta. And the simple context of things, why did I put on a bearish trade in Meta? Because Meta is completely and totally unscathed. It's unscathed against tech. Anyway, I put on a bearish in-out spread. It's $5 wide spread. I paid $2.25. Okay, right now, if I were to sell that spread, it's going for $2.75. I didn't even wait for $2.75. I entered it for $2.25. I closed it, okay, for $2.93. Okay, so I didn't wait. When I say I didn't wait, there's a rule for in-out spreads. If you make 30% the first 3 trading days, take the money and run. That's exactly what I did. But I'm just trying to show you with these in-out spreads, you come in here, right? You're defined risk. What's the worst that could happen to you? But still, my heart, I could lose 225. You can't lose 225 today, people. This trade, okay, was September 6th. This thing had 30 days to see degrees of profitability. What did it take? Like 3 hours. Okay, it took like 3 hours. Again, you have to come in here. You got to understand it's about defining your risk. It's about picking an entry point. You don't even have to be that good. You just have to be there. Like, did I know that Meta was going to spin around from the highs today? Absolutely unequivocally not. Okay, I thought it could take 2-3 days. I could have been dead wrong. This thing could have shot to 530. I just felt, look, the odds with this volatility of us coming back down, that's the trade I want to be in, people. I want to use in-out spreads. And I'm trading in-out spreads like crazy. So I've got Meta. I'm in. I'm out of that one. That's it. I made 30%. I'm in, I'm out. I'm on with my life. I have another one on HYG, and I actually even executed a trade into TLT today. Right? And if you're kind of curious about the TLT spread, well, what did I do in TLT? I actually got bullish. I got bullish in here. Why? I think there's going to be a flight to quality. So in TLT, I got bullish. Let me tell you something right now, and I want to be very clear about this. I could be dead wrong. Oh no, we pull back for 3 or 4 days. Who cares? Like, what? You think we're not going to get above 97 anytime, okay, between now and what? Well, in the TLT trade, I'll actually bring this one up, albeit briefly. In the TLT trade, I'm out to the September 13th expiration. I got 37 days. 37 days in that one. By the way, I have only filled a handful of contracts in here. You can see there's almost 1,200 that have traded. That's all right. I got plenty of time between now and the close to get executed on the remainder of those. But those in-out spreads, the place to be. Now, why am I using in-out spreads? Define my risk, okay? I'm not trying to pick exact entry points. As I said, that's futility. Just wrapping myself around the volatility. Moreover, I'm doing in-out spreads, waiting, okay, for the bigger punches in volatility so I can sell more option premium. Like, look, as I said, you got to stop worrying about the vol. You got to learn to love it. Like this is what trading is made of. It's not about getting long and praying we go up. Okay, long could be wrong, and it could be wrong for a long period of time, because right now, this two-sided action, this is where you want to be. Okay, this is what trading is really about. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.